Hello, everyone. If you want to show us who you are, that would be great. We'd love to see you. If not, that's fine too. I'm Lori Kaplan. I will be your mediator. I will be your panel host today. I know I met some of you earlier this morning, so this will be a continuation. I hope everyone enjoyed the morning session. Our topic today is managing the dynamics of a family business. And I want to introduce the people on our panel. I am going to start with Jim. If you could tell us who you are and your involvement with family businesses, et cetera, and your background, please.
Sure. Thanks, Lori. Good morning, everyone. I'd say it's a pleasure to see you all, but as we know, that's not always the case these days. First and foremost, I'm an entrepreneur and business owner, having started and exited several organizations over the last 25 years. Currently, I am an equity partner and area president at Focus CFO. We bring in fractional CFOs to help business owners reach their personal and financial goals and grow the value of their business. In addition, I'm a certified exit planner and have the pleasure of working with business owners to help them to create transactional value and harvest that value. It's a pleasure to be here.
Thank you, Jim. Mark?
Yeah, hi everyone. My name's Mark Lapicus. I'm with Apple Growth Partners, principal here, work in our tax department. Apple Growth Partners has 4 offices, Northeast Ohio. We work with privately held businesses. I primarily deal on the tax side of things. I do a lot of succession planning, work with companies to try and, figure out the best route to transition their business. We typically start the conversation very early. I always think of it as in, going in phases. 3 to 5 years out, this is what you should do. 1 to 3 years out, then the transaction's intimate. So that's a little bit about me. So Apple Growth Partners, tax partner over here, and work a lot with privately held businesses on transitioning to either the next generation or potentially a third-party sale.
Great, thank you. Amanda?
Hi, I'm Amanda Sarp, and I'm with New York Life's Advanced Planning Group. We're a consulting group within New York Life, consisting primarily of attorneys. Myself, that's my background. I'm an attorney. Also some CPAs, and we advise clients in several different areas, but one of those being business planning. And we really focus on buy-sell planning, business succession planning, employee retention, and executive benefits.
Thank you, Amanda. And I'm your panel host. I'm Lori Kaplan. I'm with Eagle Strategies, I'm a financial advisor. I work with businesses, closely held businesses in the areas of business planning, succession planning, buy, sell, and really the family dynamics, especially, buying out that brother that you didn't like, who's not doing anything, or how do we compensate someone who's not active in the business, but owns part of the business, and all things that many of you on this panel may also be experiencing. So this is an interactive session. And what I'd like us to do is I'll throw out some questions out there to our panel. But if you have something that you want to ask, please do. If you don't want to ask it, but you still want it answered, you can private chat me. I'll be checking the chat, and I can ask it on your behalf. So I'm going to start and just throw a question out to our panelists. You have a primary business that you started, you want to leave it to your family, maybe the second generation. What do you recommend, and how early do you expect? Do you want families to start in planning that succession? Jim, I want to start with you, and then if the others could hop in, that would be great.
Sure. So, Lori, just to make sure I understand the conversation, is at what point do you begin that transaction, right? And,
right.
I would tell you that you can't ever start early enough, first and foremost. If you were listening to Mr. Asher, I thought it was really interesting, his comments on how his dad had brought he and his siblings into the business at a very young age. They held family meetings on a regular basis to talk about the business, what it was, how the kids might get engaged. And it sounded like he's continuing that same practice with his kids. So I don't think you can ever start early enough. Unfortunately, what we tend to see is business owners bring their kids in typically after school, whether it's college or a trade school of some variety, and just begin to interact them at different levels within that business. I think it's got to be something that's communicated over a time period. We're working with a business owner today that is, dad is struggling to let go. So those transactions can be very, very awkward. The key factors in our minds are communication first and foremost of expectations, a clear defined timeline, and then checkpoints along the way to make sure that the next generation is got things in order and is capable of handling those different responsibilities.
Does anybody want to add to that?
Yeah, I completely agree, Jim. Often we run into clients who are looking to transition their business to the next generation, but the next generation may have only been really minimally involved in the business up to that point. So, absolutely to, just echo what you said, I think really thinking and planning as soon as possible is imperative, and really making sure that we've kind of maybe made a list of the necessary skills, the knowledge, the character, the experience that your successor will need to successfully run the business, and make sure that we've actually brought our successors in and have started developing those skills. And then certainly communicating the plan to all of the other employees and members of the management team, because I think it's also critical that when a new person takes over, they're going to be well received and respected. So we want to make sure that everyone is on board with the ultimate transition plan, and that we've really developed our successor before they're put in the position of taking over the company.
I agree with both those comments. It's never too early to start planning and having that conversation. Typically, what I'll see is two ends of the spectrum, where sometimes the children, parents may have thought that the children wanted to be involved in the business, then come to find out 10 years down the road, the children have no interest in it. You're stuck with doing a third-party sale, or finding some people internally that are able to transition the business to. Or on the other end, kids want the business really bad. They want to take it over. They want mom and dad out of the picture, but they might not necessarily have the skill set yet to develop to run that business. So, what I almost always recommend is to bring in an industrial psychologist to kind of meet with both sides, to meet with parents, to meet with children, to meet with the key management team, because that could be a portion of the equation as well. If you have, a child in the business that you're thinking about leaving it to, that child may have, a lot of the skill set that you're looking for, but they may need a, sales manager or an operational manager. And it doesn't have to be an equity piece. You have to bring them into the transaction, but you should start thinking, who should they surround themselves with? Who are the right people on the bus to carry the company forward? And some of these key people, if you leave the business, would these key people consider leaving after you left? So what are some incentive programs? Maybe it is equity for some of these other key people, and maybe it's not. It could be something like, phantom stock program where they share in the upside of the company. It could be, there's all kinds of different ways to incentivize people, but you can never start too early to have that conversation. But I certainly, step one, I think, in evaluating, hey, I'm thinking about transitioning the business, is to start looking at some of those HR functions, the personalities of the people involved in making sure that you have the right people, on the team.
Great. Thank you, Mark. Thanks, everyone. Well, that kind of doesn't that lead to another question? What happens if you don't have the right people on the team? What happens if dad wants to leave it, dad and mom, Or what happens if, hey, dad dies, dad and mom own this jointly and dad dies, or one of the partners dies and one of the spouses dies, and it's a family business, but the one that was the primary driver in the business passes away. The other spouse, male or female, is holding the bag, and you've got children that aren't developed. Has anyone run into any of that? Or is that something that anyone else is concerned about? I mean, it can get really dicey. I sit on a lot of calls, and I know that it can be dicey. I'm going to throw it out to the panel. Do you have any insight on that or experience?
Yeah, we run into that scenario all the time. I'm honestly that's kind of a horror story, a bit, and a talking point that we use when speaking to business owners. You know, we advise them not to run into that scenario. Ideally, we'll have some sort of contingency plan in place, some sort of buy-sell agreement or some sort of succession plan set up in advance to avoid that. And in that scenario, you're left with a lot fewer options, particularly if really that's the family's only source of income. That may be, you know, an event where we're sort of, you know, putting the business up for a fire sale in some scenarios. So certainly a situation we want to avoid. And that's something that we certainly bring up with clients when we're initially talking about the business. You know, what happens if you aren't able to come into work tomorrow? What happens to the business and what happens to your family? And let's put some plans in place to make sure that both of those are taken care of.
I would also add that, you know, in that case, so the buy-sell agreements, fantastic to have, and, you know, having language in there to spell out, you shouldn't just say, you know, the one owner is required to sell to the other owner in the event of death, disability, retirement, or termination. Should really spell out kind of what that amount should be. What I like to recommend is an annual valuation. It can be an agreed upon. You don't have to pay a third party. You don't have to pay a guy like me or my firm money to do a valuation. You could do a back of the napkin EBITDA calculation, and you guys agree on the value of the business every 18 months so that it's good for at least a year. And if something happens within that year, then, you know, you have it set out. This is the value that we agreed upon. If someone, you know, passes away, you're not in a argument between, you know, the spouse of the deceased and the individual, or the individual who's disabled, because you've actually spelled out what that value should be in that agreement. And, you know, life insurance, or making sure that you have the necessary cash flow if someone passes away who's an integral part of the operations, your chances are you're going to have to hire someone or promote someone or pay someone more to do that person's job, that role that they were functioning before. So does the company have the necessary after-tax cash flow to sustain paying someone to do that role, to move forward? And if not, then, you know, life insurance can be a good option to mitigate. You know, so life insurance not only for the buyout of potentially, you know, a spouse or, you know, family of a member, but also in the event of, you know, to pay to fund operations, because you need to bring someone on to do that job. One other thing that I always like to bring up is, if someone decides to, you know, one day someone says, hey, I'm done, I want to sail the world, you know, in that buy-sell agreement, you know, you should consider a clause where you don't incentivize them to retire, to, you know, quit early, call it. So there should be some type of discounting in there as well, in the event that someone at, you know, age 50 decides that they're done working and they just want to, you know, go off and not be involved.
Yeah, I would echo those comments. The hard part of all of that is tough for a lot of entrepreneurs and business owners, is that they're so busy day to day in the business, they don't have the time to step back and get to 10,000 feet and really look at, you know, the classic work on your business, not in your business. And too many times we see business owners that are just looking to grow the top line and not taking consideration for addressing those structural issues in the business that are going to create transferable value, not just a larger entity. And by that, what I'm talking about is internal structural issues, people, HR, obviously, human capital issues, looking at your customer base. If you're in a small business and you're doing everything, unfortunately, if one of those distressing issues occurs, whether it's death or divorce or disability, the business often can't survive. So in addition to just trying to grow the revenue and grow the profitability, you've got to create that transactional value with the systems within the business to ensure that it can move forward. So, you know, the buy-sell agreements, those things that you need in place when those things occur are really secondarily to the fact of, do you have a transferable asset? And too many times, unfortunately, we don't see that in the really smaller businesses that we sometimes interact with. So that's the glamour and the challenge of being an entrepreneur and a business owner, right?
Right.
Lori, can I jump in there for just a second?
Yes, Rick.
Our definition of a successful business is a commercial profitable enterprise that works without you. And linking back to the first question, the ownership is not a position in a business. And so you want to build your business in a way that it doesn't require you to be in the business as an owner. That doesn't mean you necessarily don't want to have a role in the business. You can, but set it up, as Jim was saying, structurally, so that all the pieces are in place. The salary potential is in place. You separate your salary from your draw as an owner, so that the business can run and you can hire your replacement should something happen. So you always start your business with the end in mind and work systematically to build the structure and the team so that you can retire, so you can take a vacation, so you can do any of those good things that come with business ownership.
Yep, well said, Rick. I think it's always easier to get in business than it is to get out.
Right. Has anyone on the board or anyone in the audience, I guess, experienced where a business wanted to, you know, has, I think we talked about it briefly, but you have that parent that founded the business. We talked about the founder of the organization. And then you have the children, in essence, paying them a salary because they hadn't prepared for their transition out of the business. And the hardship that has provided for the people that are running the business in terms of capital for reinvestment or whatever it is that they need to do to help grow or buy machinery or whatever the case may be. Does anyone want to speak to that?
Yeah, Lori, I'll take that question. So, you know, a good way to transition a business is through a good, in any transaction, there's always three parties. You have the buyer, the seller, and the IRS. So a way to shave out the IRS's share of that transaction is through the use of something called deferred compensation. So really how that would work is at the time of a transaction, you would enter into an agreement with the seller of the business to say, hey, you know, you have to do a compensation study. So you have to kind of compare what their compensation would be if they were in the open market as compared to working in this business. And if you can deem that they were underpaid during that period of time, whether it be 10 or 15 years, you would book that as a liability on the company's balance sheet, bringing down the value of the stock. So you're getting less allocated to the deferred compensation. What is deferred compensation? It's a non-qualified retirement plan. So it's kind of like taking money out of your 401k plan. So you get payments, the company pays the exiting owner an amount, let's say it's $100,000 a year. That's a tax deductible item for the company and it's income to the person receiving it. But if the company can get a tax deduction, stock's not deductible. When you make a stock payment, you can't get a tax deduction there. But if you can get a tax deduction at a 37% tax rate, which is the highest marginal individual tax rate, you now have taken $100,000 payment and you've reduced it to the point of you shave $37,000 off of your tax bill in making that payment to the exiting owner. So it's a good way to if someone wants to continue to receive that stream of income similar to their W-2 wage, deferred compensation is a great way to tax effectively achieve that. And in a transaction, it really shaves out the IRS. It allows the company to pay the seller more money for the company, because the buyer is now getting a tax deduction for those payments, so they have more after-tax cash flow.
So, Lori, I want to hijack this if I misunderstood your question, but I thought I was hearing you say, the patriarch is paying the kids in a situation where they're spending dollars maybe where they are not the wisely spent, shall we say, where you're not working with somebody that's maybe accountable to the responsibilities of the business. Did I misunderstand your question?
I think you did, Jim. I reversed it. I'm the child. I own I'm running the business. We're moving forward, but I still have dad on the payroll. Dad didn't fund his retirement, but and it's hard for him to give up those shares because he needs the money, because he needs to live, because he hasn't done the planning in all those years that he has owned the business. And he's looking at this as his retirement nest egg, and it's saddling on the next generation.
Well, I guess I think Mark's comments definitely then are applicable to that situation and ways to save some funding. But I think the real issue was in the structure of the transaction when it first got agreed to. And, the only way to address that is, once you're in that situation, you're pretty well in deep doo-doo. You've got to address that with dad ahead of time. Now, we have seen transactions. Actually, we've got one right now where we're going back and redoing the transaction with mom and dad. But if you're in that dire a situation where that's just a tough situation that you're kind of too late to the party, unfortunately. So regrettably, I don't have any great comments that are going to solve that problem.
Does anybody, Dave, do you want to jump in?
Yeah, I'll just chime in. So my CEO group met on Friday, and this was a very dominant issue of the conversation. We had one group, one business owner. He's got his children in the business. When they started the business, the thought was that one of the children would be the leader that would take over the business. But now that the business has been around for 6 years, dad wanted out after 3, and the children don't want to run the business. So he's in a difficult situation, as you imagine. And they're not ready to run the business either. So either you invest and try to find one of the children that wants to run the business, or you've got to kind of reinvest things. Fortunately for him, he doesn't need to take a salary out of it, but he needs somebody to run the business other than him. So from an executive search standpoint, we may need to go find someone to actually run the business for him. Or we need to simultaneously find one of his children that are willing to do the things that they need to do to be able to run the business eventually. But we do this little exercise where we hand out the death card. And it's an interesting exercise, but what happens if you died today? Is your business ready for that? If you stepped off the curb and by some chance you got hit by a bus, or in today's world, you went to a nightclub and you got COVID and died. What would that look like for your business? And so we had like this checklist that we had to have in place. One was a key man policy that would take care of keep the business afloat for a little while through the benefits of having that life insurance policy on that individual. Then perhaps conducting a search for that replacement and giving the time and bringing in someone like Jim Gilbride's organization to help run the organization for a little bit. Those are all things that have to go into play, and having that strategy is a very difficult thing to do. Business owners don't want to think they're going to die someday. They think they're going to want to be there they're going to be there forever. They're invincible. But realistically, that could happen, with the turn of the clock to the next day. So, we had and Mark, you brought up a really great point too on the valuation. One of the other members of my CEO group, they have 18 family members in the business. And one of the things that they've done is in their agreements, they have one of the clauses is that you have to be a blood family member. So family members that marry in, they're not eligible for a percentage of the business. And the other piece of it is that on an annual basis, they value the company and they publicly share that valuation with all the family members so everyone knows. So in the event that death card or a divorce happens, they know what their 50% would be or what their 100% would be, depending on the situation. So great discussion, I think, from everyone in the group. And I just wanted to share those couple thoughts with you.
Thanks, David. And I'll just tag on a brief comment to what everyone said already. Really, and this is a recurring theme for business planning in general, but the earlier you plan, the more options you have, and the easier it will be to structure something like this in an advantageous way, like Mark mentioned, especially with the non-qualified deferred compensation. If you plan with enough time in advance, there are, other vehicles besides company cash flow that you can use to fund a non-qualified deferred comp obligation. Life insurance being one of those, but you have to have the runway between when you set the plan up and when those payments are due in order to be able to utilize some of those.
Once again, start with the end in mind.
Right. And that's what we do. I mean, when I sit as a financial advisor and I'm working with business owners, my first question out of the gate is like, when do you plan to exit? How do you plan to exit? You have a family business. What children are going to be in this business? How are you training them? Are they coming from the bottom up? Are they coming in at a different tier? And what, how are you planning to do that? And are they on board with your decision? And then what happens, then we all have any of you run into the circumstance where everything seems to be lined up and then a child goes off the rails because there's a bitter divorce or there's a habit, whether it's drug or alcohol, et cetera, that all of a sudden it gets real dicey because there's a rough patch that could be going on with your successor, who is your child. I don't know if anyone has run into that kind of dynamic, if they want to speak to it or how it's addressed on the front end in planning.
This is kind of a disability situation, and that's probably the hardest challenge to be faced as you look at the management structure of an organization, because you just don't have a clear outcome. Death is a much simpler equation. It can be equally as debilitating or more so, but disability is the toughest issue out there. There are plenty of things you can do to insure some of the cost, but the damage within the business can be really devastating. I would go back to the conversation around building that structure within the organization. So if you are the lead person, you can step out and the business can run without you. Whether that's, a sibling that's in a smaller role, if you've built that structure and if you have an enterprise organization as opposed to a smaller, what some folks would call just a job, you've got the ability for the organization to move forward. As I said earlier, the challenge of building that in a privately held business can oftentimes be overwhelming. So you oftentimes need to get some help that maybe your staff doesn't currently have the skill set to accomplish, whether that's in the accounting area and tax planning, whether it's in insurance, operational or HR. There's plenty of resources that can help you address some of those shortcomings in your organization. It's just part of building the organization to create the structure that's going to allow you to overcome those issues when they arise.
Right. And to your point, Jim, you can certainly insure to protect some of those events. And if we're in a buy-sell context, you can make some of those events also triggering events for a buy-sell. If we're talking about an owner, divorce, disability can certainly be triggering events. But the difficulty we always have there is we can't predict when those may happen. And those are more difficult to address. We may not have yet adequate funding for those type of triggering events. And if it is something affecting, a key employee or management personnel, as opposed to one of our owners within the buy sell, that can have consequences within the business as well that we may not be fully prepared for. But some things you can do to put some guardrails in place, and then also, to Jim's point, really just doing the planning early and setting structures in place that hopefully the business can continue to operate even if we do have an event like that.
Right. Right. And it's just tough. I've had a couple of those just in my own experience where, and it just sets the business back, especially if the business hasn't done their planning properly. And depending, as someone said, I think it was Jim, it's really, or as Rick would say, as a coach, you need to take those days to work on your business, not in your business. My most successful personally clients that are business owners are the ones that have taken the time or will take the time to do the planning and put a trusted advisory group around them that have their best interest in the interest of their business moving forward, by having those trusted advisors. Family dynamic situations are tough. Has anyone here, or is anyone here experiencing the second family? They own a business, they have the first family, and now they have the second family. And now you've got this business, and where does the business go, and how does that structure? I'm going to throw it to you, Mark. I'll throw it out to you first. We talk about the trophy spouse and who brings their own children to the table, and how do they integrate in, and where do you address that? And does that ever impact the family dynamics of a business?
Yeah, it does impact the family dynamics of the business. It's difficult to have, someone who hasn't been in the business for a long period of time. What I would, I haven't, I don't run into that very often, but what I would say, what I always recommend is to do estate planning. Nothing's worse than, you build up this business, and you build up this wealth, which is, you can't really touch it because all your money's in this business. Something happens to you, spouse gets remarried, something happens to the spouse, and then now whoever she remarried, their kids inherit everything. Your kids don't get anything. So what I always recommend is have assets in a revocable trust. Then in that trust, you can lay out who your beneficiaries are. So maybe in that trust, something happens to you, and the trust says, hey, your shares go into trust for your children. They transfer directly to your spouse, and then if your spouse can do that after the fact too. But if your spouse then remarries, they always run that risk of basically the last survivor gets everything. So. Yeah, I don't have too many clients that have remarried and the kids have come into the business. I guess what I would say, kids don't really come into the business. They anticipate or they expect something from that business, especially if there's been a lot. So what I have seen, Lori, is equal share. So when something happens, so you might have kids that are working in the business, kids that aren't working in the business, trying to divvy up assets. That's probably the most difficult part that I see business owners run into, because you don't necessarily want to give a child or stepchild or whoever it is equity or ownership in that business, because that's just going to create a headache for the child who is operating the business. So typically what I'll see before people in their estate plans, they'll divvy out assets to say, hey, this kid who's not in the business gets our cash and gets our vacation home and gets, whatever else. And then the kid who's in the business gets the business.
Yeah, I would agree, Mark. I think you have to decouple these issues. If the kids and the family are not, actively involved in the business, then you've got an asset. How you choose to separate your assets to your spouses and your kids that's a very personal issue that you can discuss in some kind of an estate planning scenario. If the kids are in fact parts of the business, maybe that makes it more complex, because now, how do you throw the value of the business and equate that to the kids that are working in there, and so on and so forth. So, this is a conversation that I think can be decoupled depending on where those people are and how they engage with the business. Mark's comment about, bring in good advisors for this stuff. It's an interesting conversation whenever you sit down with your business partners or your spouse and you start talking about what's going to happen when. And, it's not always a pleasant subject, but as we all know, Father Time is undefeated. So you're either going to deal with it ahead of time on your terms, or somebody else is going to get left with the mess. So do it early.
We run into that scenario often, and I do think it is best addressed by estate equalization and having a conversation with the clients about how equal isn't always necessarily equitable. What we're really looking for is an equitable transfer where all of the heirs are taken care of, and everyone receives something that is going to be fair, even if it's not equal. And it may not make sense if some children are involved in the business and some aren't. If certain children are bearing the risks of the business, putting the work into the business, does it make sense that they're sharing equally in the profit and in the value of the business? So looking certainly if we have other assets within the estate that we can leave those non-active, children that aren't working in the business, or if we're very, very concentrated in that business asset, can we artificially create some assets for the children that aren't involved in the business through life insurance or some other means?
I ran into a situation, I think it was 15, 18, 20 years ago, where there was a manufacturing company, and it was a father who had two daughters, and the one daughter actively worked in the business and was making the decisions and was expanding the business, her and her husband. And the other daughter had equal amount of shares, and she could never, who was off to the side and was not involved. So was an inactive member, but was a shareholder. And it became very complicated when there were decisions to be made to expand by purchasing equipment and reinvesting in the business, because this other adult, was like, yeah, but where's my dividend, or where's my money? So it's that goes to that estate equalization and the structure ahead of time, where the father, I think at that time, thought he was doing the right thing, but yet it wasn't, because this person who was actually working in the business and on the business and expanding the business was really, hamstrung by this other person who just didn't have the vision. Have any of you run into that, or does that resonate with anyone?
One of the things it's related to this, it's not exactly the same, is get the salaries right. Everybody that's working in a business gets a market rate wage. And so if you have a person, we've run into the situation with multiple siblings, and somebody's in the CEO role, pay him the CEO pay. And if another sibling is down on the shop floor doing shop floor work, pay him that wage. Separate it at that point from the ownership of the business. You still need to address the shares and the ownership, but start with not paying everybody equally. Pay a market-based wage so that when that person leaves the business, the salary is there, connected to that role, and that can be replaced, separate from the ownership stake in the business. I think that's a key mistake that a lot of small businesses make.
Not just small ones, Rick. I'm familiar with an organization that's, 7 family members, a variety of different levels of engagement. They all earn the same income. In a situation like that, you get yourself handcuffed and crippled. And, I think, again, we're kind of talking about, you got to do proper planning ahead of time, unfortunately, because I've seen some of those situations, and it's just nearly impossible to fix at that point.
Here's a question from the field. Are there any positive or negatives on gifting versus selling shares to a family member?
There's a few different considerations to bear in mind. One's not necessarily better than the other. It just kind of depends on the specific circumstances of the family. First being, if you're gifting shares, you are ultimately giving away a source of your income. Do we have adequate resources? Have we, adequately funded retirement? Are we really at a point where we're looking to start giving away that business, or do you need to get a source of income in return by selling it? So really looking at, the income needs of the client is going to be a primary consideration. Another one is certainly a basis issue. Anything that you gift during life, the basis of the current owner carries over. So if we, have stock with a very low basis, that's now become very valuable. Let's say this is Apple stock, for example. If you gift that during life, your very low basis carries over. If that is ultimately an asset that's going to be sold by the person who it has been gifted to, you're looking at a pretty large capital gain. Whereas if you're gifting something at death, leaving something that way, we have a step up in basis. Or if we are selling that, you're going to get a step up in basis to whatever the sale price may be. So it depends somewhat on, do you have income needs? Do we really need to sell versus gifting? If you need to get something back during this transition, and are we looking at a potential sale down the road, and is that basis issue important as well?
So on that point, good points, Amanda. On that point with the pending election here in 7 days, there could be some changes in gift tax exemptions. Right now, everyone gets it's about 11.5 million, so call it 23 million between couples. Most Americans don't have an estate or gift tax problem at this point. If they are reduced to a certain level, it could be, this could be the year to accelerate any type of gifting that you might be considering, substantial gifting. But I also, when I get asked this question, should I gift it or should I sell it? The comments are, is there anyone else in the, if there's siblings that aren't in the business, are they going to feel resentful that you gifted this business rather than sold it? Because if you're selling it, now you're transferring, they're paying money to the parents' estate, which could be inherited by that other sibling. And you should also consider looking at the tax rate spread. Because, in retirement, chances are you're not paying, the highest income tax rate at 37%. If you can get a payment over to the parent at, let's say, 22%, and you get a deduction at 37%, well, you just save 15% annually in tax on $100,000. You're saving $15,000 a year in family wealth by selling rather than gifting. So I always recommend doing a quick analysis. Well, it's not always quick, but doing an analysis to determine, is there some tax savings if we gift, and kind of understand the circumstances.
Very good point. Also, Mark, about looking at the relative tax brackets, that can certainly make a difference. And also to your other point, we may see some changes depending on the election. I know Joe Biden has made some proposals about making any kind of transfer really a taxable event, and incurring those capital gains charges even when things are gifted during life. We have yet to see what will happen, and even in the event that we do have a change in the White House, what exactly may be enacted. But always things to look at when evaluating whether to buy or whether to sell versus whether to gift would be certainly looking at tax brackets, the tax consequences, and the income needs of the person who's looking at transferring those shares.
Just two more points on that too. And, this is all, what if, election based, and I'm not trying to, get political. I'm just, kind of given the tax background. But the step up in basis, I know Biden said would go away. So right now, you pass away and someone inherits, they get it at fair market value. You sell it the next day, you're going to have zero gain. So you inherit something, you go to sell it the next day, you're going to have a substantial gain, which could, which would result in some tax, most likely. But the other piece of it is doing away with the capital gain rates, because right now, this kind of concerns me quite a bit, because if you're looking to sell your business, and chances are you're probably going to sell your business for more than $1 million. So your business, and you pay a 20% tax rate today, as compared to, he's talking about the 39.6, reversing the Trump tax cut, which should move it up to 39.6. If you sold, after whenever change in, came along, your tax just went up by 20%. I don't see a lot of business owners looking to sell. And if that happens, I think that the gifting strategy probably, you got to really look at it a lot more closely, because you're not getting, there's just a lot of changes that could occur. I think Trump stays in, everything will kind of stay as is. If Biden gets in, he's laid out this plan, which, for good or bad, it's just, something to be aware of.
Mark, Lori, I think Mark and Amanda both make a very good case as to why you need to make sure you have good advisors when you're making these decisions, right?
Jim, you took the words right out of my mouth. I was just saying you need to have trusted advisors that are current, not the family friend, not your brother's uncle, not any of that. You really need to have people that are expert in their area. And I've seen that time and time again, personally, when I've worked with businesses, and looking at the people that, you are who you surround yourself with. And if you really want your business to be cutting edge in terms of the tax, in terms of the law, in terms of the documents, et cetera, you need to find those areas of expertise, because there are accountants that specialize over here, and then there are accountants that specialize over here. And you have to figure out which is the right accountant, which is the right attorney, which is the right financial person, which is the right fractional CFO type person, who are the right talent to surround yourself with to help with those decisions. Has anyone here had anything to do? We have a question here about a family office. And I don't know that if anybody wants to jump in on that, and how a family office can impact a business, or how to expand that role of a small family office. Kind of changing topic a little in our last 10 minutes.
Well, I think, Mark, you have some comments. Looks like you're good.
I was just going to say, yeah, I do work with a few family offices, and, getting, I guess the biggest thing is getting the right team in place to run that family office, because, you essentially, you could be investing in, I don't know if you're investing in, if you're invested in public companies, it's pretty easy, just find the right financial or find the right investment advisor. But if you're looking to buy private companies within that family office, or the real estate or whatever it is, get someone knowledgeable that understands the industry to run it. I probably have 4 or 5 different family offices, and what I'll tell you is that these family offices have very good people that aren't necessarily in the family advising and managing the day-to-day.
No, I think that's very well said, Mark. In a smaller environment, these are typically advisors to the business, operational people, attorneys, accountants, et cetera, et cetera. And in a smaller business, I mean, this similar type thing can be accomplished with an advisory board, where you bring in some smart people to help you handle some of those difficult questions. But it's a unique problem, but it is all about the people that you get in there. Typically, they're shared services that get spread out across a variety of organizations. If it's a family office that's investing in individual businesses, they take some of those high level services up to the family office and let them spread out accordingly.
Okay. Any other topics somebody wants to bring up that we haven't addressed? I know, I will say this, I know years ago I was working with a business, it was a large manufacturing company out on the far west side of Cleveland, and I think they were on their third, going to their fourth generation. I don't remember the name of the company. And what they did is they made all their family members work out in industry for 2 or 3 years before they came in to the business so that they could bring other experiences with them. And this was for a larger company. It wasn't, it was a manufacturing facility with lots of employees.
Yeah, I mean, the hard part in family business, if you're growing it from the ground up, is typically you get them in there for the trust and the adherence to the mission of the business. And then as the business grows, you've got to shift to accountability and skill sets. And those two things oftentimes don't align. And that's where things can get really, really dicey in an entrepreneurial small business environment.
We have about 5 minutes left, and we're gonna have a break between 11:20 and 11:25, and we have 7 minutes left. Does anyone have anything that they want, or I can just throw something out there, or that they just feel a burning desire to either hear about or talk about? Jump in from the field or from our panel.
Anything somebody from the audience was curious about? I mean,
So, okay, so here's a good question. We kind of talked about it, but what happens if you have a family business, but your CEO is an outsider? And you're moving over into that advisory role, and now you still have to bring some children up in the business, or you do want it to stay in the family. How do you handle that?
I think this is a good opportunity for that incentive compensation. So, incentivize that person through the use of, maybe it's phantom stock. It could be deferred comp. Deferred comp can be discretionary. Phantom stock doesn't have to be tied to anything. You can do a discretionary award every year. But that's a good way to basically, and what I'm saying by phantom stock, if people aren't familiar, but you could put money aside to say, hey, if the company earns, let's say $1 million a year, we're going to put 5% into your retirement plan. So 50,000 in that year, and you can collect it upon reaching retirement age, and you set it all out in the plan document. You would set a vesting schedule. So say this person's 30 years old, well, they can't touch the money until they're 60. Typically there's vesting in between. Maybe they vest 1% per year, 5% per year, whatever it may be. But it's a good way to keep that CEO on the book, because who wants to walk away from a large retirement package that they're not going to get somewhere else?
I think it's valuable to sit down with the CEO and understand what their goals and objectives are, right? And understand what their timeline is, and what the timeline for bringing the kids into the business. And where do we see that individual's the one that's going to have to coach those kids up day in, day out. So understanding their role in helping that occur, and to Mark's point, some deferred comp or some, a golden parachute to help them at the end, assuming they get that accomplished. But also making that individual, if they're going to stay, aware that they're going to have impact on deciding if these kids can handle these roles, because you don't want just somebody sitting in that chair with a title. They've got to be invested, and they've got to be committed to the objective.
If you want to give your business the best chance at success, and put your children and the next generation in the best position to be successful, really keeping the right people in the right seats is going to be critical. And doing that through some sort of executive compensation plan, some sort of golden handcuff, is a great way to help ensure that.
The ability to manage and lead is not connected to your education level either. And this is a mistake I've seen with small families. Coaching a business, a manufacturing company, where one of the sons in the business has a business degree, and the other son has a high school diploma. And the high school diploma son is a natural manager. He could lead a 500-person plant and do an amazing job at it. And the business degreed son, I wouldn't give him a job. And yet the mindset is flipped because of the importance of, quote, education. As you move up in ranks in managerial ranks in the business, the problem solving abilities are step change different. And somebody who is really good at the shop floor is not necessarily good at the next level or the next level. And that's where the Peter principle comes from. So knowing the capability of the players, be they kids or not, is really critical, because if you elevate somebody to a managerial position where they have to define and design and build the systems of the business or improve the systems of the business, and they are not capable of doing that, your business will implode over time. And so getting that right and understanding the capabilities required of each role and the capability that people bring to the party, really, really important for the business to succeed and for the succession to succeed.
I agree. And I think that that's, unless there's something anybody else wants to jump in and say, I think that may be a good stopping point, unless Amanda, Mark, Jim, final words.
Thank you all for attending.
Yeah, thank you.
Thank you, and plan early is, I think, the overarching theme.
Right. Everybody's contact information is available for to contact. Amanda and I have done a lot of work together, phantom stock, executive benefits. We have had a lot of success together, working together, and helping businesses move forward. So I want to thank everyone for coming, and we'll see you at the next session. Bye.
Thanks.